Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm here solo to talk about what are the hottest stocks to buy in 2024. I feel like there's kind of a secret going on out there in the stock market this year that many people might not have realized, but there's been a big rotation. We always talk about rotation in investing because it's kind of a thing, right? Where the money is in one asset class and moves into another, or in one set of type of stocks, say, the banks, and then it moves into another one, say technology. But I'm feeling like we're seeing a big rotation out of the pandemic winners and into a new set of winners that looks pretty obvious when you start to really dig down into what's going on out there. And it looks obvious that the pandemic winners are being discarded when you compare it with what's happening with the current day winners and hottest stocks. So I thought I'd do a little bit of comparison between some of the hottest stocks that are out there right now, comparing them with what were the hottest stocks during the pandemic, and some stocks which I know many of you are hoping will be hot again. And maybe that's why you're holding on to those stocks. We're still following them every quarter when they report earnings. They're still being featured. People still chatting about them on Stock Twits or on X and thinking that they're still among the hot big names, but they're really not. These other stocks that I'm going to talk about have supplanted those pandemic winners in a big way. And even when the earnings outlook is still looking pretty good for some of those pandemic winners, the street is just not caring. And that's a sure sign that they've been kicked to the curb, as we might say, and new winners have been chosen. And really, as an investor, even if you're a short-term investor, but even if you're a long-term investor, you might want to still consider looking at some of these that are the hottest stocks to buy here in 2024. Now, I'm not going to look at any of the meme stocks. Those are back again. Yes, it's back to 2021, which fits into the theme of this podcast, right? So I'm not looking at GameStop. I'm not looking at AMC. Those are surging once again here in 2024 as apparently Roaring Kitty posted something on social media. Everybody is thinking he's back. Oh, let's have some fun again. And, they're into those two stock names again, up big, up over 100% in only a short few days. So those are hot, but for different reasons. So I'm going to stick with what's hot on the fundamental side and what's been hot all this year. And some of these stocks are big names and big caps that are breaking out to new all-time highs. Even while the pandemic stocks, the former winners are lagging, seriously lagging. So let's just dive right into some of these names. Now, I just picked some of these stocks off the top of my head. I didn't do any kind of screen for this podcast, even though you can screen on Zacks.com for stocks that are trading within a certain percentage of their highs. And that's how you can get stocks that have momentum that are hot. But I didn't even have to do that because a couple of these stocks, I either own some of them, or I own them in the insider trader or the value investor, or I've just been kind of following them for a number of years. And I know that they're trading at all-time highs. And so let's see what these are, because you might be surprised. Some, again, you have heard of in the past, others you have not. And for those of you who are listening, I am going to share my screen on the YouTube video version of this podcast. And I'm just going to show the price and consensus charts for these. It is my favorite chart here at Zacks.com. You can find it on the left-hand corner in that gray section when you're on Zacks.com and you put in a ticker and go to their quote page. The left-hand side column will say charts, and then it says price and consensus there, and you can click on there to find these charts. But what does this chart actually show you on the price of consensus? It shows you the price of the stock, obviously. And then the left-hand side, it'll show you the consensus estimate, what the earnings estimates are expected to be. Now, this data goes back 5 years, and it basically shows the attitude or the beliefs of the analysts, because that's what the consensus is. It's the changes in analysts' estimates over the course of the period they're looking at these years. So the analysts might start off very high on a company with a high consensus for 2024. And then as the year goes on and maybe the company doesn't live up to those expectations, they have to cut the estimate. And so the estimate starts to come down on the chart. Or it goes the other way, which is what we like to look at, where they give the estimate to start the year or, in the year before, because they're always looking forward, and they were too conservative. So they have to raise their consensus, or they have to raise their estimate, and that raises the consensus. And then you have the lines going up and to the right. That's what you want to see. You want to see big spaces in between the lines because that's earnings growth year over year. And then you want to see it going up because that's also earnings growth. And I think you'll be interested to see when I compare what some of these hottest stocks look like now with the price to consensus chart versus what the formerly hot stocks look like. And maybe, it seems pretty obvious why they are no longer hot stocks when you look at the price and consensus charts on some of these, but not all of them. There's always a little caveat in there, right? But we'll get to that in a minute. So let's dive right in. And I'm starting off with the first stock, and it is Skechers. Yes, the shoe manufacturer. It is one of the hottest stocks, breaking out to new all-time highs. And as you can see on the chart that I'm showing, it's at the highs right now here in 2024 in May. And that's because they just reported a really strong first quarter, better than expected. One area that had been struggling was their wholesale business, which is the department stores or any store. Like if you're buying the Skechers at DSW or somewhere like that, that's their wholesale business. They also operate about 5,200 of their own stores, and then they sell online. Now they are global, and all of their countries are doing really well right now. Apparently, if you like the slip-on shoe in the United States, you're going to like it in the UK. You're going to like it in Thailand. You're going to like it just about everywhere because that is among their most popular type of product globally in almost all markets, they said. But looking at this chart, you can see the earnings up nicely for 2024, expected to be up 15.2%. The shares are actually up 10.3% year to date. So not that big of a boom, even though they're at new all-time highs. The S&P 500 right now is up about 9.5%. So they're just beating it a little bit here, but it's all going in the right direction. And PE is actually very affordable here at 16.9. So it's not at some nosebleed valuation levels. Now, I own Skechers in the insider trader portfolio here at Zacks because some insiders did jump in to buy a couple of months ago. After the first quarter, when they said fourth quarter results, but it happened earlier this year, when they said wholesale was struggling a bit and the shares had sold off. So some insiders bought, we did too, but now, our patience is being rewarded here with Skechers. Now, I wanted to look at another stock that was one of the pandemic winners and one of the red hot retailers to just show you kind of the difference. And I chose Lululemon here. Now, I own Lululemon in my own personal portfolio, and I have for a couple of years, but you can see the earnings look, very good and outstanding here. Up and to the right, every year earnings growth expected to grow for fiscal 2025 up another 10.8%. So they're still doing double digits, but it has slowed a bit, and that spooked the stock market, and people sold it off this year. So it did hit new all-time highs at the end of 2023. So it had the highs in 2021. It sold off. It managed to retake it and then some, but it has sold off again. Now, this pattern is going to be a little unusual with the stocks I'm going to talk about today because the others peaked in 2021 but did not resurge like Lulu did here. So Lululemon, ticker LULU, is now down 31.7% year to date. PE is still pretty stretched at 24 times, not as high as it was, but still pretty stretched. So this was a pandemic winner. It had those highs in 2021 and even 2023, but it has withdrawn from those highs here and is struggling a little bit here. So Skechers is the one with the momentum. The shoes have the momentum here and not the athleisure, which is maybe peaking out here a bit as we enter mid-year 2024. Okay, let's switch over to restaurants. There's a lot of hot restaurant stocks, many of them hitting new highs, but I went with the old standby of Chipotle. Now, I used to call this the king of the restaurant stocks. Ticker is CMG, but then it was replaced by Domino's for a while when Chipotle had some of its problems with, they had PR problems. Then they had, the store issues with some of the food. And then that went away. And now they're back again. And no one remembers any of that going on, right? So Chipotle hitting new all-time highs here in 2024, which is a tremendous breakout. It's not cheap. It has never been cheap, but it used to trade around 40 times. It's now trading at 57.8 times. But look at that earnings growth, big double-digit earnings growth, and to the right, consistent growth year over year. Hard to do that when they've been doing it so many years. But 2024 earnings expected to be up 23%. So that is just tremendous right now, especially with these inflationary pressures and the consumer possibly pulling back to see earnings up that level. Year to date, shares are up 39%. So like I said, this is one of the hottest stocks of 2024, but not cheap by any means. But you're paying for the growth, right? But compare it to another stock that is among the favorites of the restaurant industry, Starbucks, ticker SBUX. I own it in my own personal portfolio and have for about a decade now. But look at the very big difference in the earnings outlook. So it too, over the last couple of years, has big growth in earnings, double digits until right now. And now the estimates have been cut both for this year and next year off of that very disappointing earnings report that it just reported. And so now fiscal 2024 earnings are expected to be up, but just 2.5%. Again, compared to Chipotle up 23%. And so this stock hit its all-time high in 2021 during the pandemic when, it was kind of the only place you could go to get something, basically. And they were crushing it in same-store sales, especially in the U.S. and especially on the reopening from the pandemic shutdowns. But its drive-thrus were crushing it up until the reopens. And then it sank in 2022 and has struggled ever since. And now we're back down to those 2022 levels once again. So what does the PE look like here? It's still a little stretched. It's still at 21 times as those earnings are cut now. So it's not dirt cheap here. Year to date, the shares are actually down 20.9%. So you can see just the obvious difference from one of the hottest stocks like Chipotle to one that is not multi-year or close to multi-year lows here in 2024. Okay, let's move on to another grouping. I'm going to talk about travel now with Booking Holdings. Now, I own Booking Holdings in my own personal portfolio, but to be honest, a lot of people, when they think of Booking Holdings, which used to be Priceline, they think, oh, that stock has done so well. But really, even just looking at this chart from the last 5 years, it had a big period where it was basically just consolidated in a narrow trading range, going almost nowhere. And then it sold off in the pandemic in 2020. It got back into that narrow trading range, but it wasn't until last year when it finally busted out of it, and then it's been taking off. But you've had to wait around, as I have had for many years, without a dividend, which they only just announced and started paying one. So up until that point, it was kind of dead money and was underperforming the S&P 500. But now it's busted out to new all-time highs. And Earnings 2024 have recovered off of the pandemic lows and are now expected to be up this year, up 17.3%. And you can see that steady gains in the price and consensus chart up and to the right over the last 3 years off of those pandemic lows, 2021, where it was still sinking as things remained shut down, but then slowly has been rebuilding back up. And now you can see they're at the 5-year highs here. And that's what you want to see as an investor. But year to date, even though these are at new all-time highs, it's still only up 5.6%. So kind of still being ignored by the stock market to some extent. And PE is fairly attractive for booking here with this kind of earnings growth of 21 times. Now, that's the same PE as what I just said on Starbucks, which was stretched. But Starbucks earnings are going down and bookings are not right now. So booking only at 21 times, you're getting growth at a fairly affordable price. The ticker is BKNG. Now, I couldn't really find a true travel comparison from the pandemic with this one because all the travel stocks kind of did poorly in the pandemic. So I'm comparing it to Shopify because that was a big pandemic play and also really popular with a lot of investors. I believe it was in Kathy Wood's ARC Innovators fund over there, her flagship fund. But this was a huge winner for many years before and during the pandemic. And I just put up the chart, and this is kind of a crazy price to consensus chart, right? The price and consensus plunged in 2022 with the earnings plunging there. And then it's been kind of a rocky road ever since. It is going up into the right now. So that's a good sign. But the analysts don't seem to know for sure. So they started off very high with the earnings, then they had a cut. Now they're slowly raising those earnings estimates, but it's kind of up, down, up, down, up, down. And currently, 2024, the earnings are expected to be up 29.7%. So that's fantastic growth. But year to date, the shares are still down 2.6%. And remember, the all-time highs were back in 2021. And this stock is not cheap. That could be the reason maybe why the shares are still weak, even though earnings expect to be up double digits. PE of 61 here. So that's really stretched. And for whatever reason, the stock market now has decided they're not willing to pay that much for these earnings like they were in prior years, where the stock also had an expensive valuation. But now they've decided, nope, not paying that for this. And that's where you see what I was talking about earlier with the rotation. The sentiment has changed on the stock. It's no longer buy at any price. It is, I'm not buying at this valuation. So that's a changing of the guard. And that's the difference between what we're seeing here and seeing with all of these hottest stocks. Chipotle, nobody's there yet. Who cares if it's trading at 57 times? I'm willing to buy that earnings growth at any price, and people are. But Shopify, rotation is out. It's no longer in one of the in stocks. And so the stock market is punishing it to some extent. Now, if you're a value investor, you might start snooping around into some of these names looking for value. But with the PE of 61, I'm not really seeing it quite yet here with Shopify. So even as a value investor, I'm sitting on the sidelines. Okay, let's move into an unusual area that you wouldn't think would be among the hottest stocks to buy here in 2024. It's a bank. It's JP Morgan Chase, ticker JPM. This is the first time I think I've had a bank on the hottest stocks in, an episode like this in I don't even know how long. But I just put up the chart and you can see that it is breaking out to new all-time highs here in 2024. Hard to believe, but the stats aren't even that great. Look at that price and consensus. We have 2023 earnings looking higher than 2024, which is looking about the same as 2025. So that's not that great. It is going up and to the right, But the earnings growth does not look good here because the lines are like almost right on top of each other for 2024 and 2025. And for 2024, earnings are expected to be down slightly, just 0.1%, but still down nevertheless. So why is it breaking out to new all-time highs? PE is at 12. So that's pretty cheap on a PE level. But for banks, you got to look at the price to book ratio. And remember, the bank analysts always say, buy at a price to book ratio of 1, sell at 2. And this one, JP Morgan now has a price to book ratio of 1.86. So it's getting a little pricey on the price to book ratio side, but the street doesn't care. That's why it's one of the hottest stocks right now to buy in 2024. This is a sign of the rotation again, where even though fundamentals underneath it aren't that great, right? Like this just isn't that great. But the street doesn't care. It is rotating money into it anyways. Year to date, the shares are up 17.5%. So money is definitely coming in to JP Morgan, believe it or not. And so this is among the hottest. But let's take a look at one of the hot financials from 2021, from the pandemic era. And it would be one of the fintechs, which is Block. This is the one I chose. Block, which still has the S as in Sam, Q, the square ticker. Can't get the block, but it's someone else says that one, so it can't get it. So it's still using the square ticker SQ. And look at this pricing consensus chart. So this looks pretty good to me. It is up and to the right. I've talked about Block on other podcasts, especially on the Value Investor podcast, but it's still not. You're not seeing it in the shares. The shares are still being punished here. The all-time highs were in 2021. It's nowhere near them. Year to date, the shares are down 7.6%. They're down back to not quite here in 2024, back to 2020 lows, but it did look like it tried to test those or got close to it in 2023. So it's just in this narrow trading range again, which is how I described booking all those years. So when the stock goes out of favor on the street, it can do this. It goes into this narrow range, but it does mean it can get cheaper, especially if you have a scenario like this with the earnings expected to be up. So 2024 earnings expected to be up 74%. So that's tremendous, right? But the shares, again, year to date, down 7.6. So is it cheap? It's trading with a PE of 22. That is cheaper than where it used to be, but not dirt cheap on a value investor basis, which I do look for under 15. If Block gets to under 15, I will be taking notice. I will be sitting up for that one. I did look at the price to book on this one, even though it's not a bank, but it's fintech. So the price to book is at 2.3. That's pretty low as well. Not as low as JP Morgan, but still pretty low. So the valuations are looking pretty interesting with Block, but the street is rotated out. They are rejecting this one. They're going for the banks. And that's where the momentum is. And that's why JP Morgan at all-time highs and Block at multi-year lows here, basically, or near what it's seen even in pre-pandemic levels. Okay, now I have just one more pairing to talk about. And this is basically the hottest tech trends and like infrastructure and trends. So the stock I chose for this one, you may or may not have ever heard of it, is Sterling Infrastructure, ticker S as in Sam, T as in Tom, R as in Robert, L as in Larry, STRL. And this one is in Zacks Value Investor portfolio. We've owned it for maybe a year or so, maybe not quite a year now. And its name tells you what it does. It is a construction firm that does infrastructure. But why is it among the hottest stocks here? It is busting out to new all-time highs. It has been basically all year long. And that's because it's building data centers. And we know how hot those are. They're being built all over. If you don't have a data center being built in your state, you need to move to a state that has data centers, because that's where it's at. And that's what's going to drive AI. You need massive amounts of data. You need those chips. And so we need many, many data centers. And so Sterling's, they're doing other stuff too, but they are in the data center side, and that is driving their business. So new all-time highs, as I mentioned, year to date, up 46% here. 2024 earnings expected to be up 14.8%. And you can see on the chart, slow and steady up and to the right. And we are seeing that double-digit spread in between this year, last year, and then look at 2025, another good year expected from the analysts there. And the better thing about this one is that the analysts are not keeping up with the story and what's going on. They're putting in their earnings consensus, their estimate, and then Sterling is beating and raising, and they have to raise again for the consensus. So it's like a ladder or steps going up and to the right. That's very bullish. That's a lot of momentum, and the company is doing something right. Something good is going on behind the scenes. So Sterling, what kind of valuation? It's now trading at 25 times. So much more expensive than when I bought it in the value investor portfolio. But we are now seeing this nice growth. It has transitioned basically over to a nice growth stock. So if that's floating your boat and you're looking for these hottest stocks and you want a data center type of stock, then Sterling should be on your short list here. But what am I going to compare it to? Well, I chose Zoom Video because Zoom was the kind of hot thing like the data centers during the pandemic when we all had to be online, either working, going to school, visiting, with friends and family. We were doing it on video and in video podcasts like this. So Zoom Video, I'm putting up the chart, and you can see it peaked in 2020, actually, not 2021. And then we had the big sell-off. So ticker here is Z as in zoo and M as in Mary. It's just the two. It's just ZM. But look at those earnings. This is kind of an interesting one. The earnings have not collapsed. The earnings have kind of stayed steady, and they are kind of up and to the right now for 2024, 2025. The analysts are not bearish on the earnings here. Earnings for fiscal 2025, they're about to report first quarter fiscal 2025, are expected to be down, but just 6.1%. So they haven't, they're not collapsing off of what we've seen in prior years, but the stock has collapsed. So therefore, we're seeing a cheaper valuation than we ever have on Zoom Video. PE of just 12.9. And year to date, these shares are still down 11.8%. So they might not have stopped falling. And they're right around the pre-pandemic, or maybe even a little lower than the pre-pandemic levels when they really took off once the pandemic hit, because we were all like, hey, we're going to be at home using this technology. So this is an interesting comparison, but also an interesting price to consensus chart to really see what happens when the rotation happens. And the street determines, hey, we're done with this, we're getting out. And the earnings aren't really following. The earnings are okay. They're not great, but they're only okay. But the earnings here are not all that much different than what JP Morgan Chase's earnings are kind of looking like. The lines are right on top of each other for 24 and 25. So not much earnings growth on both companies, but Zoom Video stock remains depressed, and JP Morgan is busting out to new highs. So you want to be, if you're looking for the hottest stocks out there in these popular areas, the ones that have momentum higher, not lower, obviously, and the ones where the rotation is now on. And you also have, for the most part, fairly good fundamentals underlying it, boosting it and providing that floor there. But as we've seen, some of the ones where the rotation has come out, the pandemic winners that are no longer winners, also have decent fundamentals like Block does, for instance, and even Shopify that are looking fairly well, but they've just been kicked to the curb, as I said earlier, and they are now out of favor, heading more towards the value side of things than they are on the growth side. And a lot of momentum and hot stock investors want to be in that growth. So usually those go hand in hand. And so those are where you should be looking here. So it's interesting to see the change in the rotation. I think this will happen and keep happening through the remainder of this year. So I'm keeping an eye on these hottest stocks for clues. But if some of these ones that are now out of favor get even cheaper, then as a value investor, I will be poking around, and you should too. But for now, the sentiment still seems on the negative side on many of the former favorites, and it's still very bullish on these current favorites. So you might want to put some of these on your watch list and keep an eye on both the current and the former lists for future investing opportunities. Okay, let me recap all the stock tickers because there were a lot on this episode. So there was Skechers, ticker SKX on the shoe side. It's looking pretty hot. And, again, all-time highs, but valuation's not too bad. Ticker SKX. Then we had Chipotle. It's about to split. So if you're thinking, I can't afford $3,000, Tracy, I could only get one share or half a share if I try to buy that, then wait for the split and you will have a little more accessibility. Ticker C as in Charles, M as in Mary, G as in George. Then we had Booking Holdings, formerly known as Priceline, ticker B as in boy, K as in king, N as in Nancy, G as in George. I own Booking in my own personal portfolio. Then we had JP Morgan Chase, a bank is in the hottest stocks. Oh my gosh, what will be next? Ticker J as in John, P as in Paul, M as in Mary, JPM. Then we had the unique one, Sterling Infrastructure. You might not have heard of it. It's on data centers, ticker S as in Sam, T as in Tom, R as in Robert, L as in Larry. And then the ones that are out of favor, Lululemon, which I also own in my own personal portfolio, ticker L as in Larry, U, L as in Larry, U, LULU. We had Starbucks. I also own that one. In my own personal portfolio, ticker S as in Sam, B as in boy, U, X as in X-ray, SBUX. Shopify also still remains out of favor, ticker S as in Sam, H, O, P as in Paul, S, H as in Harry, O, P. Then we had Block. Its earnings are looking interesting, but still out of favor. Ticker S as in Sam, Q, because it's got the old ticker, S as in Sam, Q for Block. And then Zoom Video, it's cheap, but nobody wants it here. Ticker Z as in Zoom and M as in Mary. Just two letters, ZM for Zoom Video. And as always, you want to be sure to subscribe because you never know what I'll be talking about every week here on the Market Edge podcast. But there's a lot going on. We have the stock market near all-time highs once again on the S&P 500. So be sure to get us somewhere. You can get us on YouTube at Zacks.com/YouTube. Put in Zacks Investment Research to get the video podcasts. Or if you want to just listen to us, get us on Apple, we're on Spotify, we're on Amazon Music, we're also on SoundCloud, but get us just about anywhere you can get podcasts. And make sure you subscribe so you don't miss a single episode. And I'll see you again next week with some more stocks.